Risk associated with direct investments into private companies. In another video, we talked about the potentially huge returns available through direct investments in early-stage companies. One example was Andreessen Horowitz' $250,000 investment in a company called Instagram, which was later purchased by Facebook for $1 billion. With this sale, Andreessen Horowitz earned about $78 million on the initial investment of only $250,000. Unfortunately, for every one of these examples, there are thousands of stories of investors losing all of their investment. Historically, out of 10 angel investments, 3 or 4 will be complete losses, meaning you will lose your entire investment. Another 2 or 3 would generate small returns or return the initial amount. 1 or 2 would be decent investments, returning 2 to 3 times your money. At most, these returns may cover the losses from the other 5 to 7 investments. But only one investment would be a home run, generating 10 to 30 times your money. In a recent study by the Center for Venture Research at the University of New Hampshire, about a quarter of angel investor exits in 2011 were actually company bankruptcies. However, about half of exits provided investors with a profit. The annual returns of these varied greatly, but often exceeded 20%. Why do so few investments pay off? What are the risks, and are there ways to mitigate these risks, even if sacrificing some of the potential upside? In this video, we will discuss the types of risks associated with direct investing in early-stage companies and some approaches to minimize your family office's exposure to these risks. The main types of risk in early-stage investments are technology risk, market risk, risk, management risk, financial risk, liquidity risk. Let's look at each of these closer. Technology risk. For most companies that are developing something new, be it new software, a new device of some sort, or a new mousetrap, the most important first step is to design and make the new thing. After all, they can't sell it if it doesn't work. This is one reason why so many angels and venture capital firms invest in high-tech companies. It takes a lot of money to build a working model before any revenue can be earned. This upfront investment is what investors pay for. The risk is, even after millions of dollars invested in R&D, the new thing simply doesn't work. As an investor, how do you protect yourself or your family office's clients' money? The most common approach is to invest in tranches, essentially installments. Instead of investing, say, $300,000 in a startup company still working on developing a new technology, agree to invest $100,000 now to get them started, another $100,000 after they reach some agreed upon milestone, and then another $100,000 when they reach another milestone. If the company fails to hit a milestone, your loss is limited to only the amount you actually invested. One key mistake many investors make is pouring good money in with bad money. If the company does miss a key deadline or fails to hit a milestone as planned, be wary about investing more. As they say, if you find yourself in a hole, stop digging. Look at each tranche as a new investment, without considering the amount that you've already sunk into the company. Market risk. Assuming the technology works, there is still the critical step of actually selling the new whiz-bang thing. The files of the U.S. Patent Office are filled with innovative products that never made any money. Sometimes entrepreneurs are ahead of their time. Others miss a key detail that dooms their company. One high-profile example was Pets.com, which sold pet products online. Customers, as it turns out, didn't want to wait several days for dog food or kitty litter, when they could just go pick up a bag at their local grocery store. Still others suffer because of market conditions that change beyond their control. These market risk conditions apply to all companies, not just high-tech startups. Think about all of the restaurants that have closed because of the lack of business. But startups are particularly vulnerable because they don't have other revenue streams or markets to fall back on or to cover their losses. What are some approaches to mitigate market risk? Perhaps the simplest technique is to only invest in what you know. Many professional investors, such as VCs, specialize in certain industries or sectors in which they have experience or are confident the market will value and pay for related products. If something sounds amazing, but you have no way to validate the opportunity, you may be setting yourself up for failure. In addition to your experience, seriously evaluate the experience of the management team in the field. Do they have a proven track record in the industry? Competitive risk is closely associated with market risk. Will the company be able to successfully compete and sell in the marketplace? What is a risk that an existing, established competitor will offer a better product or service or better value? What is a risk that a new competitor will emerge and copy your company's offering? You can mitigate some of the risk through some practices already discussed. First and foremost, of course, is due diligence. Far too many entrepreneurs will tell you, we have no competition. But even a 5-minute web search can find similar products or services, or even other solutions to the same customer pain point. Second, invest in tranches. One tranche may be based on filing patents on any valuable intellectual property. Another may be based on securing a key customer or strategic partner. Usually, a first mover advantage is not a sustainable advantage unless the company can find ways to build high barriers to entry for their competitors. Third, as a reminder, evaluate the management team's experience and ability. This brings up perhaps the biggest risk: management risk. Many entrepreneurs start a new company because they are an expert in the field. A great baker may open a bakery. A great engineer may start an engineering firm. Unfortunately, being a great baker does not necessarily mean that you are a great business person. Knowing how to write innovative software code does not mean you know how to manage millions of dollars of revenues and expenses, how to lead a company of 1,000 people, or maximize shareholder value across an entire enterprise. Poor management can destroy otherwise promising companies, delay or derail technology development efforts, miss market opportunities, or lose market share to competitors. How can you mitigate this important risk? First, consider the management team's management experience, not just ability to make a product. Also, consider the coachability of the entrepreneurs. Are they willing to listen and learn? Are they willing to step aside and bring in seasoned executives to run the company? Insist that the company first secure significant investment from the founder's friends and families. If people who know the founder are not willing to bet on them, then perhaps you shouldn't either. If you make an equity investment, consider common stock with voting rights, or even demand a seat on the company's board of directors. This way, you have formal authority to add your expertise or block management from executing flawed strategies. If you make a loan, require personal guarantees from founding management team. You can also insert various performance clauses in the investment documents that either reward the founders for good performance or penalize them for poor performance. The main reasoning behind this is to make it easier for them to overcome pride enough to sacrifice their titles and bring in experienced management in order to protect their investment. As some consultants tell entrepreneurs, 10% of a $100 million company is much better than 100% of a bankrupt company. Finance risk. Let's say the product works, and the product then sells. In fact, it is clearly better than the competition. Further, the management team is executing well. All the risks discussed above are not an issue at all. All is okay, right? Not necessarily. You may have been fortunate to get in on the ground floor of a very promising young company, but getting in on the ground floor means that there will be other opportunities later for investors to get involved. Of course, there'll be less attractive terms than what you received. That's why you got in when you did, right? Still, the company may need to raise more money from other investors later. It may need additional financing for market expansion, further product development to open multiple locations, or another infusion to fuel the growth you expect. This is where finance risk may come into play. Sometimes the deal for new investors is so unattractive itself, no investor will put the money in, despite all of the attractive attributes of the company. What does this mean? For example, The pre-money valuation may be too high in order to provide earlier investors an increase in value. Perhaps earlier investors, including you, have high liquidity preferences or other terms that would make it nearly impossible for later investors to realize much of a gain. Maybe there are just too many investors in the company, which may raise SEC questions or just pose too much of a logistical nightmare for professional investors coming in. There are countless ways to soil a deal for later investors, which in reality soils a deal for early investors as well. One way to mitigate this risk is to think about what the deal would look like for future investors and avoid any abnormal terms. You may even benefit from networking with venture capital firms or PE firms to learn more about their preferences. If you feel that you can only win from a deal if you negotiate for very favorable terms now, you will eventually lose. It has to be a win-win. So don't make the investment unless normal terms would work for you. Of course, this only applies for companies that will need multiple rounds of financing. Not all companies do. The best way to mitigate financing risk is to invest in companies that can thrive, fueled only by this investment round and margins from operations. Liquidity risk. A key difference between private companies and public companies is the fact that stock in public companies is readily and easily traded. You can almost always sell your stocks within a day. Private companies are a different story. You can't easily sell your shares in private companies unless there is a clear exit event. You can exit, or cash out, of the investment when it is acquired by another company or investment group, goes public in an IPO, or when management buys you out. Sometimes companies can operate for many years generating just enough profits to survive, but not enough to be attractive to an acquirer. Angel investors call these companies walking dead. You can't realize a profit or even write it off as a loss for tax benefits. You can mitigate this risk by identifying clear exit strategies and possibilities before you enter the deal. You can also negotiate for dividend payments that would at least provide some return on the deal if it can't be exited. Or you can opt for a debt or convertible debt arrangement if the exit is not clear. In conclusion, direct investing in private companies is inherently risky. Perhaps the best overall approach is to employ a clear portfolio strategy. Only start direct investing if you will be able to invest in at least 10 different companies. If you have $1 million to invest, be prepared to invest an average of $100,000 in each company over time. Remember, you don't want to invest all $100,000 at once, but over 2 to 3 tranches. So realistically, you need to make 20 to 30 distinct investment decisions. In the public market, you can buy puts or holds to mitigate risk or hedge against potential upswings or downswings in the stock price. In this video, we covered a few strategies that you can deploy in private equity as well.